Hello and welcome. When you look at your investment statements, you'll see a lot of numbers vying for your attention. Your account balance, your gains and losses, your allocation. But there's one number that's easy to miss, often buried in the fine print. It seems small, insignificant. It might be 0.5%, 1%, or maybe 2%. It's the fee you pay, the expense ratio, the advisory fee, the fund management cost. It's tempting to think, what's the big deal? It's just 1%. But I am here to tell you that this tiny percentage is one of the most powerful and destructive forces working against your long-term wealth. It's a silent leak in your financial boat, and over a long voyage, it can sink you. In this video, we're going to run the shocking math. We'll show you exactly how a seemingly small fee compounds into a massive fortune for them, not for you, and give you a simple framework to plug the leaks and keep more of your hard-earned money. So let's follow the money. To understand the true cost of fees, we need to appreciate the other powerful force at work: compound interest. We love compound interest when it works for us. But we often forget it works against us with fees, a phenomenon we might call compound expenses. Let's do a side-by-side comparison. Imagine two investors, Alex and Taylor. They each start with $10,000 and invest an additional $10,000 every year for 40 years. They both earn an average annual return of 7% before fees. The only difference is the fees they pay. Alex is the low-cost investor. She invests in a low-cost index fund with an expense ratio of just 0.05%. Taylor is the high-cost investor. He invests in a fund with a seemingly reasonable fee of 1%. Let's see what happens after 40 years. Alex's portfolio grows to approximately $2.36 million. Not bad at all, but what about Taylor? His portfolio grows to approximately $1.75 million. Did you see that? That tiny 1% fee cost Taylor over $600,000? That's more than $500,000 that vanished, not because of a market crash or a bad investment, but simply because of a fee that most people would consider low. But wait, it gets worse. That $600,000 didn't just disappear into thin air. It was transferred. It became revenue for the financial company. Your compound interest became their compound profit. The financial industry is built on this transfer of wealth, and it happens silently, year after year. Now, you might be thinking, okay, I get it, the expense ratio matters, but that's only part one of the story. The expense ratio is the main fee, but it's often not the only one. To be a truly informed investor, you need to know what else to look for. First, there's the expense ratio itself. This is the annual fee, expressed as a percentage of your assets, that all mutual funds and ETFs charge for management, administration, and other operational costs. This fee is automatically deducted from the fund's returns, so you never actually see a bill for it. This is your number one focus. Next up are transaction costs. When a fund manager buys and sells stocks within the fund, there are brokerage commissions and something called bid-ask spreads. These costs are not included in the expense ratio, but still reduce your return. Actively managed funds, which trade frequently, have much higher hidden transaction costs than passive index funds that just track an index. Then we have advisory fees. If you work with a financial advisor who charges a percentage of your assets, like 1% per year, this is an additional fee on top of the expense ratios of the funds they put you in. So, a 1% advisor fee plus a 1% fund fee means you're giving up 2% of your potential returns every single year. Think about our example earlier that can easily cost you over $1 million in the long run. Finally, some brokerages or advisors charge annual account maintenance fees. It might be a small flat fee, but it all adds up. The combination of all these fees is your total all-in fee burden. This is the true percentage of your wealth that is being eroded each year. Okay, so now that you know the enemy, here's your battle plan to defend your wealth. It's a simple, 3-step fee defense plan. Step 1. Become a fee detective. You can't manage what you don't measure. For every single investment you own or are considering, you need to find the expense ratio. It's in the Fund's prospectus, or you can easily find it with a quick online search for the Fund's name plus expense ratio. Once you have that number, benchmark it, compare it to a low-cost alternative. For example, for a US stock fund, the benchmark is an S&P 500 ETF like IVV or VOO. both of which have an expense ratio of just 0.03%. If you're paying 0.5% for a similar US stock fund, you are overpaying by a huge margin. Step 2. Embrace the power of passive. The single easiest way to slash fees is to move from high-cost, actively managed mutual funds to low-cost index funds and ETFs. The data is overwhelming. The vast majority of actively managed funds fail to beat their benchmark index over the long term, especially after accounting for their higher fees. By choosing a passive index fund, you are virtually guaranteeing yourself a market-matching return while keeping almost all of the gains for yourself. You're not trying to beat the market, you're just trying to be the market, and you're doing it for a fraction of the cost. Step 3. Negotiate or eliminate advisory fees. If you use a financial advisor, you need to understand exactly how they are compensated. Fee-only advisors are generally the best option. They charge a flat fee, an hourly rate, or a percentage of assets. If they charge a percentage, ask if they offer a flat fee plan for simpler portfolios. Be very wary of commission-based advisors. They are paid by selling you specific products, which creates a major conflict of interest. Their incentive might be to sell you a high-fee product, not the best one for you. Also, consider self-managing. With the abundance of low-cost index funds and free educational resources online, it has never been easier to manage your own portfolio with a simple 3-fund approach. Ask yourself, is the advice I'm getting worth 1% every single year, forever? For a $500,000 portfolio, that's $5,000 a year. You could pay a fee-only planner for a one-time financial plan for a few $1,000s and then implement it yourself. So let's quickly recap. The cost. A small 1% fee can easily cost you over 25% of your potential lifetime wealth due to the destructive power of compound expenses. The culprits. The main fee is the expense ratio, but watch out for advisory fees and hidden transaction costs. And the cure. Become a fee detective, switch to low-cost index funds and ETFs, and critically evaluate any ongoing advisory fees. In the world of investing, you can't control the market's returns. You can't predict what the S&P 500 will do next year. But you can absolutely control the fees you pay. And the math is crystal clear. Minimizing fees is one of the most reliable predictors of long-term investment success. Don't let your future be the foundation of a financial advisor's retirement. Every percentage point you save is a percentage point that compounds for you for decades. Guard your basis points like your financial future depends on it, because it does. Thank you so much for watching. If you found this helpful, please hit that like button and subscribe for more content to help you build wealth. See you in the next video.